So in this session, we're going to discuss about the current market setup, what's going on, what's happening around us, and what kind of scenarios it is throwing. Extremely volatile set of days for capital markets across the world, not just India, but honestly across the world, we have seen massive sort of volatility that has kind of engulfed markets. Uh, Obviously, there is a crisis. With respect to India, there are, if you just look at what's happened with the markets to begin with, let's just look at some of the global markets. These are monthly charts for some of the major markets in the world. So this is S&P 500 US, and it practically peaked at around 3,400 in February, and from there went all the way down to 2,200, 2,100 in a span of practically 5 weeks, right? To give a sense, we are back to 2016 kind of levels on S&P 500 in a span of 5 weeks, essentially, right? This is Germany, which is even worse. DAX from Germany, which fell from something like 13,800 odd levels all the way down to 8,100 odd levels. Again, in a span of 5 weeks, much lower than the levels that were seen at a low in 2016, about 5 years back now. India, again, have given up almost all the gains that we had kind of accrued post 2016 and did actually breach this low as well. So we did make a low around 7,500, did something well today. So markets kind of had a mild recovery today, which resulted us in Nifty being at 8,300. But that's basically been the case. And then there are more volatile markets than us as well. So if you look at something like Brazil, then you would see this kind of a crack where the market was at 1,20,000 Bovespa, as it is called, and it almost hit 60,000, which is a 50% dip again in a couple of months, right? So that's been the nature of the turmoil of the markets, and there have been a few things that have kept the markets on tenterhooks. More specifically, in India, there have been three major points that have kept our markets on tenterhooks. One is coronavirus. The second is the Yes Bank issue that happened and what followed post that in terms of the resolution of Yes Bank, and what happened with other banks as that happened. And the third is what's happening with oil prices globally. So it's sort of the perfect storm brewing globally in terms of what's going on. uh, in terms of them, we'll take them one by one. So let's start the first point with coronavirus and look at some data around that. What you see on the screen is data from March 7 and March 12. I've just taken 2 days because to kind of track what happened in cases. So China was largely stable, right? Between these 2 days, which is 5 days apart, Italy went from 4,600 to 12,400, right? You look at something like France, that tripled. You look at something like Germany, that more or less went up 2.5 times. You look at something like US, which was at 308, that quadrupled to about 1257. This is between March 7th and March 12th. Post this, a lot of these markets, a lot of these countries went into seeing exponential growth in the virus numbers, right? So this is the data as of yesterday. You could go to a website called wordometer.info and you can get this live info on an ongoing basis. So if you go back to the previous slide, you'll see Italy was at 12,000 on March 12. Approximately 12 days later, 12,000 becomes 69,000, right? US was at 1,200. Approximately 12 days later, you have US at 55,000 approximately, right? Spain, Germany, both of which were in a couple of thousands kind of numbers, went to 32 and 42,000. And so did a lot of the other sort of European nations, right? So you see a large chunk of Europe actually under this problem. And the speed of this flow obviously spooked markets, spooked governments. So countries after countries went into lockdown, which got us into lockdown as of last evening. Complete lockdown for 21 days as of last evening. Now, what's the impact of these? Uh, let's look at some quick numbers. So India's GDP is 3 trillion or around 2.2 crore rupees. Fiscal deficit is about 3.5% of GDP, and that's about $100 billion. I've taken approximate numbers, give or take a few here or there, right? So at 75 rupees USD, you will probably look at this number. Fiscal deficit is 7.5 lakh crore, right? Now let's understand the impact first. You are shutting down the economy for 21 days. Safe to assume that it's not going to revive immediately after that. So you're looking at approximately 30 days of uh, of sort of lost productivity. 30 days is approximately 7 to 8% of the year, right? Even assuming that some services will continue, some production will continue, so you'll not have a GDP decline completely. But what it means is even if at a 50% impact, you're looking at the impact at 4% of GDP right away. This is just there, right? That's going to happen just because we have shut it down. And this is the bare minimum, assuming that we will revive, go back up to speed in 30 days or so. If we don't, that's going to be another tricky problem. So the first things first, if our GDP was 100 and we were expecting a nominal GDP growth rate of 10% this year to 110, we can write that off. This is not happening. What we are more likely to see is a nominal GDP growth number of anywhere between 4 to 5%. And that's probably the base case. If this continues a little bit longer, we could actually see negative numbers for the entire year itself. Uh, that's not obviously what is critical at this juncture. I think most people understand that the safety and health of the country is a bigger priority than obviously capital markets and the economy, which can always get revived. But this just gives you a sense of, you know, what are we looking at, what are we staring down the barrel in terms of the numbers when we just look at those numbers. The second problem that comes around this is it's not going to come out of it by itself, you know, because people will take time while the trust deficit kind of gets breached. You will not start going to cinema halls or take flights immediately after this 21-day lockdown ends. It would be a slow revival of cards as we go along, right? So one of the key things that you are likely to see is, along with the shutdown, which is going to necessarily decimate the next quarter's GDP completely. And in US, we are seeing numbers for this quarter GDP and next quarter GDP to the tune of annualized numbers of anywhere between, you know, minus 24% kind of a number, which is kind of expected, because if you shut down the entire country or shut down a large chunk of the industry, obviously you're going to have no production, and that's going to create a challenge, right? Uh, it should, however, revive back quickly, because once you're out of this, then, you know, a lot of the demand issue is temporary. Some of it is permanent, right? So if I didn't travel in this quarter, it's not like I'll travel twice in the next quarter. So some of this part of demand destruction is permanent, but some part of this might be temporary in nature. So that should get revived quickly. What we are likely to see is a big monetary and fiscal stimulus by government of India, which is probably what was on the cards, and that's why the markets were probably positive today. In these times, usually most governments give up the thought on fiscal deficit, right? So fiscal deficit is out of the window. If there was a time where a government had to basically say, I don't care about fiscal deficit, but I want to revive growth, this is the time, right? And nobody would actually take that comment negatively. So, you know, essentially this is the time for the government to go up and do that. Now, what could be the necessary impact around that? India has approximately, for example, there's a, you know, one of the measures on fiscal side is what is direct benefit transfer or cash transfer to what is the Jan Dhan accounts, right? India has approximately 40 crore Jan Dhan accounts. If we end up transferring about 2,000 bucks to each of them, we are talking somewhere to the tune of 80,000 crore. That's a month, you know, per month number. So if you do that for 3 months, you're looking at 2.4 lakh crore. 80,000 crore is approximately $10 billion, slightly more than that. So for 3 months, you're looking at $30 billion being given out as that. $30 billion is about 1% of our GDP. Make no mistake, unless we are going to look at numbers which are significantly large, this problem is not going to resolve itself. It is going to be a challenge in a country where a large part of the population is either working on daily wage or is employed in the unorganized and MSME sector. There is also a likelihood that you could see a sort of a tax cut or a tax benefit for MSME sector so that they are not burdened, and they kind of go through this time without retrenching workers at this point of time. So keep an eye on these announcements. I think you are likely to see on the fiscal front, approximately 1 to 1.5% of GDP being outlined for this straight away. If you give a tax benefit to MSMEs, the impact could be to the tune of 60-70,000 crore. That's another $10 billion. So we are looking at somewhere to the tune of 1 to 1.5% of GDP being pushed out as a fiscal, sort of push. This is going to be approximately to the tune of 3 lakh crore. I would be surprised if we see anything less than this over the next 6-month period at least. So that's the extent of push that we are likely to see at this point of time. Let's see what happens and how quickly that happens. But that's the need of the day at this point of time, looking at where we are and what kind of impact we are seeing. This reduction in GDP numbers or growth, GDP growth that we are likely to see will necessarily push us as well as the entire world back by nearly a couple of years. So nearly 2 years worth of growth has kind of taken down the wind with this coronavirus issue that has cropped up. Now we'll come to scenarios in a few minutes, but that's broadly it around this, right? Some sectors have been impacted. So the next issue that had affected India's markets at this point of time was the banking sector crisis around Yes Bank, where Yes Bank board was superseded by SBI and a new board was kind of reconstituted. And since then, a lot of the private banks went up and took stake in Yes Bank. I'll not delve too much into this. There is a small simple thing, and some of us might just have seen Bank Nifty, which was at 32,000 approximately somewhere in January, correct all the way up to 16,000. That's a 50% correction in your Nifty Bank Index, right? That's been driven by a lot of the second tier banks like your IndusInd Bank or Axis Bank or RBL seeing massive dents in their share prices. Now think about it. In banking, trust is the key issue. Post the Yes Bank fiasco, if you and I were to open a bank account, which is the likely bank that we are going to go to? What are the likely banks that we are going to go to? And if you create a list of those banks, you probably take out the top 4 or 5, leave everything aside. The rest of the pack of the banking sector is going to face a tough time getting deposits in the near term, because this is a crisis of confidence. And in confidence issues, a bank that is seen with some sort of a suspicion is likely to kind of see an aggravated or accentuated, move in the prices. That's what we saw with something like an RBL or IndusInd Bank. I wouldn't have complete understanding of the financials of these, but at least from the perspective of what we saw, it seemed like people were trusting the larger banks more than the smaller banks. And it's not like the larger banks did not see a price correction. They also saw a price correction, because in India, banking, while the biggest benefit of Indian banking was retail banking channels, where consumer loans were basically given out. Now, the problem with this coronavirus issue at this point of time is that you're likely to see a big dent in terms of consumer discretionary spending. And that is going to see both a challenge in terms of growth for retail banking as well as in terms of NPAs for retail banking in the near term, right? And that's why banks are on tenterhooks at this point of time. Obviously, corporate growth is kind of affected. I think it takes some time to come out of this, but it gives an opportunity to kind of find out the next good set of banks which are available at good valuations at this point. The third problem that faces us at this point of time is the oil scenario in the global markets. Now, some of us might think that oil prices going down would be good for India. So undoubtedly they are. The problem, however, is that when you have an interlinked world which is reeling under the crisis of coronavirus already and slowing growth because of that already, this entire discussion of Saudi Arabia and Russia getting into sort of a price war creates a bigger challenge. So one fine day, you had this scenario where over a Thursday they were meeting and they were planning to kind of cut production. And Russia declined that, saying that they don't see such a big crisis around oil happening. On Friday, the markets fell. And then on the weekend, Saudi Arabia came out and said, we're going to increase production. And they negotiated lower contracts with all their buyers. We saw sort of a day where oil prices fell down by 25% in a day, right? And what that did was the oil price, which was hovering around 55 to 60 sort of dollars a barrel somewhere in the beginning of this year, are now trading at 26. Right now, what does that do? The impact is that any oil exporting economy, Middle East, for example, right? There's already a virus induced slowdown, and this is going to impact growth even more. Think of US has this entire US shale producers, right? They are only viable at oil prices above $40 a barrel. Most countries in the world that produce oil at prices beyond $30 a barrel. So if the price is below $30 a barrel, then a lot of the countries are in severe stress. So Saudi Arabia has basically pushed a lot of countries into that scenario where in a bid to kind of corner the market share, they have gone ahead and created this challenge, and that could in the near term affect a lot of the economies adversely, which in turn affects the global growth, and then in turn it affects India. In the medium to longer term, this is good for India because our oil import bill every year is approximately dollar sort of, anywhere between 130 to 150 billion dollars approximately, depending on oil prices being 60, 70. That's going to see a massive cut. So we are looking at approximately a saving of, if this price continues for a year, we are looking at 50 to 70 billion dollars worth of saving, right, in terms of the data. Now, to give you a sense, here we were talking 1 to 1.5% of GDP. That's $30 billion plus another 10, 12, $15 billion. So the entire oil saving that we are doing on an aggregate level in the economy could actually be pushed towards this side. That of course assumes oil prices remain where they are, right? And that's possibly one of the reasons why the government has not cut down oil prices and has maintained a trial to increase the excise duty that is there on petrol and diesel, because the taxes they are going to collect from there are likely going to form a part of what is going to come in the fiscal package, right? So to that extent, I think the government is also short of funds, and so they will likely have this coming out. Now, what happens next? uh, More volatility possible in terms of the markets. Stocks do appear attractively valued in the Indian markets. We have to kind of take that into consideration as that goes along. But at these kind of times, there is heightened volatility, lots of news flow. Every day you will get new numbers coming in, new data coming in, some company completely shutting down production and all that. So that's going to be a challenge. Expect a monetary and fiscal response. There are a few scenarios that could play out here now. So one of the scenarios you could see is a quick recovery. Next 2 weeks are crucial because we saw in the last 2 weeks the numbers of coronavirus across all those countries, the speed at which it increased. So for Indian economy, the next 2 weeks are extremely critical, and that's probably why the government just came and clamped down everything, saying that we can't afford this kind of a slip, right? So next 2 weeks are going to be something that you need to keep a watch out on from a markets perspective and economy perspective very closely. If we go through these 2 weeks relatively stress free and we are fine with the numbers there, then hopefully we should see a quicker recovery, right? A quick recovery would mean a recovery starting somewhere in the month of May and then kind of taking full steam in the month of June, July. A slightly more prolonged affair could take anywhere between 3 to 6 months. So you have a scenario one where you could have a sort of a quicker recovery, right? And you have a scenario two, which is where you could have a prolonged issue where you take probably 3 to 6 months. I sense that that you should be back to normal unless we are looking at a major health scare. I personally presume that, uh, uh, we will find a way around it. Most countries are going into lockdowns, and once you kind of do lockdowns, the exponential spread slows down dramatically. The impact of that is only visible after a week or so. And the next week, global numbers will throw a lot of light on that, right? Also, the numbers increase globally while it sort of shows a panicky kind of a scenario that the numbers have doubled from 2 lakh to 4 lakh in a span of about 5, 6, 7 days. It's important to understand that it's also because there is wider testing that is available across the countries. And maybe these numbers were already there, but just that people started getting tested more frequently and more commonly. And that's probably why you saw the numbers spike up. So that's broadly it. I think from valuations perspective, the markets are probably pricing in this kind of a scenario. We expect a fiscal and a monetary stimulus. The fiscal stimulus is likely to be probably about anywhere to the tune of 2 to 3 lakh crore kind of a number. The monetary response is going to be probably a rate cut, may not happen right away, because even if you cut rates by 1%, what is going to change in the near term, right? So the monetary response could be on two cards. One is basically a delay in sort of interest payments for all kinds of loans that are there for a couple of months probably. That's going to be announced most likely. And then you get a rate cut probably next month somewhere. That's not to say it cannot come now. It might come now as well, but you'll probably see a rate cut in the next, it would be more useful once you are getting out of this crisis. At that point, rates have to be cut, right? So that's probably something that we have to keep in mind and look at from the perspective of what is going to be the response. Markets were probably pricing in a lockdown, and that's why today you saw some sort of a market reaction that was positive, despite the news not necessarily being good, because that news was already priced in. You knew there was no other way out but to have a complete lockdown to the economy, right? So that's broadly it in terms of our discussion today, where we are in the markets and what is likely to happen in the near term in the future. That's it from me today.